Thanks everybody for showing up. We are just getting everybody logged on, so bear with us one quick minute and we will get things started.
What if she gave you her login? All right. How you guys doing? Can you hear me? No? Oops. Can you hear me now? Yes, thumbs up. All right, cool. Awesome. 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 All right. So we had a little bit of a snafu getting started. I apologize for that. We're a couple minutes late. I guess on GoToWebinar, you only have, depends on the license you buy, but to make a long story short, only the license holder can start the deal. And then So anyway, I think I'm logged in under Heather's account. I'm not sure, but
No, you're
we are
showing
good
you're
to
showing
go.
Andrew.
So I am going to, for those of you who don't know me, my name's Andrew with Central Lending. We're a direct lender, private lender. Many of you in the audience I've worked with before. I've got a panel with me. Jason and Jamie are here. They're both account executives with the team. And so they'll be able to take questions if questions come in. And we're going to get going in just a minute here. So let me get going. All right. Whoops. I'm going to share my screen and we'll go. How should we do this? Window. We're going to share this window. How does that look? Does that look okay? What do you guys think? Let me just. All right, cool. All right, so let's get going. So again, you're here with Central Lending. We're direct lender, private lender, home base out of Lakeland, Florida. We do private money loans for real estate investors. And I'm happy to, many of you in the audience we've worked with before. Hopefully some of you I haven't had the pleasure of meeting yet. Hopefully we do some loans for you guys soon, okay? All right. Can you see the notes on the side or just the one slide? Hopefully just the main slide. Let me just check. I kind of got like 3 screens on a laptop, so it's a little bit, anyway. You guys can throw questions in the chat as well when things come up. You're sharing your screen. Oh, it looks like the present feature doesn't work very well with this. So I'm just going to go through on. Yeah, we really need to test this next time before we go live. So anyway, this is our panel. We got Tom, Jason, Jamie, and Jason. So Tom is our chief account executive. He's been with me for a while. He has a long career in banking. He's also seen a lot of stuff in hard money loans. Jason is an account executive with us. He's also a team leader. Plenty of experience there. Jamie is great. Also a licensed realtor, but I think she likes this side of the business more because we have more fun than those guys. And then Jason Taken is also an account executive with us, but also a VIP broker. He has a ton of volume, even outside the Central Lending Network. So really well-rounded in terms of who funds what type of deals and what is out there in the market. Okay. So I'm going to start with this slide. I want to get right to the USPs. You guys have a lot of options in terms of which lenders you can use. We're not the only lender that does, hard money loans, right? So why Central Lending? You see I did my Drake meme over there. Pretty solid artwork. So I believe we're the fastest lender in the industry. I actually looked at a deal yesterday, middle of the day, Wednesday. It was a condo in South Florida, and the lender sat on it for like 6 weeks, and then finally discovered it was a condotel, right? Something you'd know on day one. Declined it, and then we had essentially 36 business hours to arrange funding, and so we successfully did that, and we're going to close Friday. But I don't know if the borrower's on board. But anyway, we're ready. So I'm not aware of anyone else that can really, there's a short list of lenders that can, get the capital together in 36 business hours, use another lender's appraisal, understand the deal, and also protect their investors, all under one roof and bring that kind of leadership to a deal. Okay. There's a small list of lenders that can pull that off. We're on that list. Closing in as little as 2 business days. Certainty of execution is high on the list. Many of you in the audience use a lot of different lenders, a lot of, table funding, correspondent loans, this and that, overseas processing. A lot of you guys buy full appraisals and you wait 3 weeks to hear from a loan committee. We don't really do that here. You pick up the phone, you give me a call, I give you a thumbs up or a thumbs down, and we move it to closing. Okay. Now I'm being a little facetious. You have to work with someone on my team who's an account executive who understands what we will fund ahead of time. But I meet with these guys every single day, so we can bring hyper efficiency to you, and we don't really jerk you around. Another thing you'll notice with us is we have very detailed term sheets, right? We don't just like throw your credit on there, the address, and say, yeah, we can do 90%. If you get a term sheet like that, you should be pretty skeptical that they're actually going to pull it off. So our term sheets go through all kinds of the issues we run into. We try to be very thorough because we want to approve your loan up front. And then all we do in processing is basically verify that the assumptions on the term sheet are true. So, most lenders kind of just build a file and then make a decision later. We make the decision up front pending the details on the term sheet being true. So we take a little more information up front to save you the headache of, buying an appraisal, turning in all these documents and wasting 3 weeks of your life to get your loan declined, right? So we're going to ask you a couple more questions up front, spend, an extra 2 or 3 minutes on the phone, get a few extra data points, get that detailed term sheet out, get it signed by you, and then we're going to fund the deal. And our track record is simply perfect. We've never missed a funding ever, and we have 1,000 transactions. So a big reason for that is the team has experience, right? The underwriting team has experience. So I've done 100 of my own specs, fix and flip, ground up, short-term rental, long-term rental, all that kind of stuff. We have actual investment experience. We can help you guys make sure your budgets make sense, make sure you're not going to lose money on your deal, that sort of stuff. Okay. And then obviously we have competitive pay for our brokers and our AEs. This is our program guidelines. So for investor rehab, we're doing 90% of the deal. Ground up and additions, we're doing 85%. And bridge, we're going up to 80%. Investor rehab is just your cookie cutter standard construction loan. Ground up and additions are, complicated projects. And bridges are where you're not improving the value of the collateral. So it's already at its max value. And we have a bunch of adjusters here. The credit, the lower your credit is, the more conservative we're going to be. The less experience you have, the more conservative we're going to be. Probably no surprises there. And we have sort of our guidelines here on the right. We're in most of the states throughout the country. The only states we're not in are some of the licensing states and some of the markets on the West Coast. There's a couple of rural markets out here. You have to have an entity to do the deal. So, basically, and any questions, just throw them in the chat. All right. So I prepared this slide because we are getting a lot of we're wasting a lot of time back and forth in processing with live deals that other people are doing. So I prepared this slide to kind of go through some of those pain points. The first thing is know your local regulations, right? A lot of people, especially new investors that haven't done a deal in that market before, are you in a historic district, right? A lot of these historic districts require certain type of windows, certain type of elevations, certain type of approval processes. If your building's contributing or non-contributing, all that stuff plays into the rehab budget that you can do. Also affects the value of your property when you're done and the way you can market it. Is short-term rental prohibited? So this is a hot button item. A lot of jurisdictions are sort of hearing, there there's a lot of jurisdictions throughout the country that are looking at this closely at prohibiting STR or licensing it, right? The short-term rental. So, just because you watch someone on TikTok show you that how you can do 5 short-term rentals, and how you make more money than a long-term rental, well, that's part of the story. There's a lot of work that goes into short-term rentals. We have a couple of them, so um, you need to be in a market where it's actually allowed. And there's also an underwriting risk of you can go into a short-term rental, fix it up, BRRRR it, and then the government can just change the rule on you. So you could have bought the deal when short-term rental was allowed, and then it could flip after you own the property, and then you're back to long-term rental. So if that's the case, hopefully you bought a conservative deal and you underwrote it to where long-term rental, justified your deal. That's also another reason why we don't like skinny DSCR loans where you have to like make the best case assumption for the rent for short-term rent to like justify a bad deal, right? So just be careful with that. You got to really understand the market you're in for short-term rental. And then for permitting, we see a lot of mix-ups here, especially with new investors. So what requires permitting? Typically, this is your exterior elements of the structure. So this is like your windows, your doors, if you're adding square footage, if you're moving like load-bearing walls, all your mechanicals, so your HVAC, your electric, your plumbing, this type of stuff, just be reasonable with it, right? I mean, if you're, we have people that, and permitting's different in every jurisdiction. We're not necessarily like the permit police here, but you also can't take a 1,000 square foot home, make it a 2,000 square foot home, and like not have a permit, right? That's ridiculous. So we have owner permits are typically prohibited. We see this mistake a lot from new investors. So a lot of jurisdictions will allow you to pull an owner's permit if you own the property. And so we have a lot of investors that think, oh, cool, I can save money if I just, pull an owner's permit, right? Well, that's every time I've looked into this, it's been wrong. So typically the owner permit exemption is if you are a homeowner, you live in the property, typically you're going to homestead the property, and you're not acting in a commercial capacity as a commercial enterprise. Typically this is the government's way of saying, okay, if you want to live in your house and manage your own deal, your own project, that's fine. We'll keep we'll go hands off. But if you're acting as a commercial enterprise, selling your property, like flipping it to other people, uh, most jurisdictions are going to want to control that with a properly licensed contractor. And if you try to do the owner permit and they catch the transfer title and they catch the owner permit, you can get in some trouble there. Again, the experienced guys know this, but a lot of the new investors try to do the shortcut here and they get burned. They can get in trouble with that. So just, get ahead of that stuff and ask questions if you're not sure. Okay. If you're doing a heavy rehab, know your numbers. This is a big one we see. So, I look at deals every morning where we're analyzing a rehab budget, and we have like a little Excel sheet we send, and like the numbers are all messed up, right? So, the more complicated your deal is, the more important it is to be organized, right? We want a specific, we want spec- excuse me, we want specific data entry for the square feet of the subject property before your project starts so we can figure out what it's currently worth, and after your project is done so we can figure out what it will be worth when you're done with your project. So 2 specific data points, they have to be accurate. We waste a lot of time going back and forth on this. You also want to distinguish before and after what's heated, what's living, right? A lot of people just say, hey, that home is 1,900 square feet. Well, what are we talking about here? Are we talking about the garage? Are we talking about the carport? Are we talking about an enclosed porch? Are we talking about patio? Are we talking about living area only? Up north, are we including the basement, excluding the basement? And then are these numbers changing before and after? And it's just extremely important that we have accurate data when we try to figure out what your property is worth today and what it will be worth when you're done, and when we try to do proper due diligence on your budget to figure out if your budget's actually going to fix the thing the way you expect it to be fixed, especially if you're new again. So just very important to take the extra few minutes, write it out. This is what it is today: square feet, living, square feet, non-living, square feet below grade. And then when I'm done, this is what it's going to be: living, non-living, below grade. Just take the extra few minutes and be very detailed with that, because it does affect your values and it affects the feasibility of your budget. Okay. The bed and bathroom count before and after. So if you're keeping a 3-2, that's fine. But if you're turning a 3-1 into a 3-2, this is a very important detail, right? So just communicate that, please, because we see a lot of like, hey, it's a 3-2 and the ARV is 500K, and like that's all the detail we get, and then we're looking at pictures and we're counting bathrooms and we're missing one, and so then we're going back and forth. The more thorough this budget is up front, the better. And then please note the extra features, right? So if you're adding, carport, if you're adding a patio, if there's a pool, that you're adding, or a deck, like anything that might play into the value that might confuse us. Because remember, we look at a lot of files, we're working off of Excel sheets and numbers. So any type of context that you can give us that's outside of like the basic numbers is just extremely helpful for us to understand your deal, right? At the end of the day, there's humans looking at it, myself included, okay? And then getting a quote for your big ticket items. Again, take this with the proper context, right? If you've done 20 flips, I'm not going to chase down your roofer for a quote. But if it's your first deal, you may want to look into what these are costing. Don't listen to what the wholesaler told you it's going to cost. Like, go figure it out, right? So yeah, so if your roof budget is, if you've never done a deal before and your roof budget is $5,000 and you're re-roofing a house in Florida, a 2,000 square foot roof with 35 squares, I've done that 70 times myself. Like, that's not the cost. So just, we're going to push back if the big ticket items are way wrong. And you can get ahead of that if you get like legitimate quotes. And by the way, it's in your own best interest to get an independent quote of a re-roof, right? Especially if you haven't done it before. Okay. Custom and unique items. So a lot of times you'll see like historic exterior finishes, pool, fence, maybe like hardy board siding, like anything where, or whatever, quartz countertops or some type of ultra high-end appliances, like any type of item. When you do our rehab budget, if you're doing a finish where the dollar amount doesn't really match the market, just detail it for us, right? If you're doing some like, you know, fancy concrete driveway or like a paver driveway or a fence that for some reason it's a very expensive fence, right? Like I had a deal in Texas where the guy had like a 40K budget for his driveway. I'm going, what the heck? 40 grand on a $500,000 house. And it was like some gate that opened automatically if the car drove up the right way, and it had pavers and all this and that. Well, that would have been nice to know. So it just helps us if we have a little more context there, and it helps us understand the as renovated value. And then add a contingency, of course, right? Those of you that have been doing this, the only thing you know for sure about your rehab budget is that you're going to get it wrong, right? The only thing you know for sure is that the amount you budget for is not the amount you're going to spend. That's the only absolute truth in construction financing. So on older homes, give yourself a contingency. We allow up to 10%, and keep that in mind when you're testing the profitability of your project. And then on newer homes, you can use a lower contingency. So, a home built after 2000, you can probably count on the structure to be good, the electric, the plumbing to all be good. It might be more cosmetic. So, you might not need a 10% contingency. So, you might lose deals by being overly cautious on these. But on older homes, you might win deals that you don't want to win because your contingency was too low. So you want to kind of have the right level of contingency for the right vintage of the home. Okay, so a home with a younger vintage, like a 2000 plus home, you don't need to go crazy on contingency. You should kind of know what it needs just from eyeballing it. On an older home, you kind of need a bigger contingency. You don't know what's behind the walls. The insulation's probably bad. The electric and plumbing probably have issues. Structurally, you may need to, kind of reframe some parts of the house. So you run into a lot of stuff on these older homes. So just keep that in mind. Always add a contingency to your budget. All right, we got some good questions coming in. So yeah, I know the slides could be larger. I try to do presentation mode, but then I'm on like a 3-screen monitor at home. It's amateur hour here, so this is our first run. So this will get better. I actually, I'm gonna give you guys the truth. I had a tonal installed today at my house, so I know this is off topic, but I'm pretty excited about it. But I had to be home to watch the installation to put it in the right spot. And then because I'm home, I'm trying to present on a laptop and I can't like control the screens the right way. So when I tried to do the present mode, it like I couldn't figure it out on my laptop at home. But we're gonna iron this. We're gonna button this up and make these a lot better moving forward. Okay. So anyway, smooth processing tips. Um, we're gonna take questions at the end, by the way. So just throw them all in the chat. There's some good questions in there. So I think we touched on this on the last one. That's the organization. So accurate property data, a thorough and detailed rehab budget. Be organized with your comps. Don't go off what the realtor told you or the wholesaler, right? Their motivation is to get a closing. I'm not saying they all act this way, but I'm saying it's just a fact. Their financial motivation is attached to the next transaction closing, right? But you and me, we're going to be partners for the next year. So I'm very interested in your analysis, and I hope you're interested in my analysis of this deal actually being successful. Okay. So just make sure you understand your comps and that we're communicating well on these comps. And then be clear about your exit strategy. I look at probably 5 deals a day where the contract was written 3 months ago and it's been kicked by a lender and it comes from a broker and then the broker says, well, they'll just refinance, and it's like, what? You know, it's just like you have to have a crystal clear exit strategy about how you're going to execute your way out of the bridge loan. Okay. So whether that's selling the property for a profit, and don't just say sell because it makes the deal make sense. Like actually say sell because they're going to sell it. Like, then we're going to check that it's going to be a profitable exit after realtor fees and so on and so forth. And then if it's a refi, understand the type of loan product that they're going to get into. And I'm not saying I'm not saying that you need to know the lending market, when we have a new president next year, but you should at least have some idea of the type of loan product that what we like to do is we like to say, okay, after the project is done, would they qualify for an exit in today's market? And that's kind of the litmus test, and understanding that the lending market might change in the next year. But, after they fix this property and maybe their credit goes up 20 points, will they qualify for a DSCR loan in today's market? Understand that today's market is going to change in the next year, but at least have some type of plan. Just saying, oh, they'll just refinance. It's a non-warrantable condo and they're a foreign national and this and that. And like, you don't know who funds those deals. Like, it's just lazy, So, please start early with the processing. So we can do the 2-day close. We've done it before, but it requires dedication and cooperation and all hands on deck. So if you have time, start early, right? If you're always scrambling at the last moment, it's adding a lot of stress to our transactions for no reason. Okay. Um, for smooth processing, there's a self-interest in this, but we recommend you work with a U.S. based team with experience. Okay, and where can you find that? Well, you can find that at Central Lending. But I'm sure there's other lenders out there as well. But uh, a lot of the lenders are very bulky, very institutional, very very large. With overseas underwriting, and they work all night kind of thing. You're disconnected from your processor and you're disconnected from the loan committee. So you never really, that's why when you're talking to your broker or you're talking to your account executive, say, hey, how's my deal doing? They kind of, those are the experience. You kind of understand the bullshit, right? You understand, hey, I just need 48 hour for underwriting review and this and that. They're shipping it off for a decision. The person that made the decision on the loan hasn't looked at it yet. So just be mindful of that. Usually, sometimes these deals work out, sometimes they don't, right? But if you can work with a lender that actually makes talk to the person making the decision, and the team is US based, and you can talk to that team, it just gives you a lot more clarity in your transaction, whether it's going to close on time and what's holding it up. And obviously, please, go easy on the team. They're working on a lot of files. They're humans, all that kind of good stuff. Some good some questions in here. All right, cool. Confirming the loan structure. This is good to do before closing. So we're sometimes we clear a deal to close, and then the borrower says, "Well, I thought I was paying for the rehab," or I thought the rehab was included in the loan, or I thought I was getting 50 grand at closing and I'm getting 10, or I didn't know the closing costs were this high, right? We kind of get some of this pushback the day of closing after they see a settlement statement. So try to confirm loans. Oops, I messed up my slides. Look at that. Oh well. Try to confirm your loan structure before the closing day. So this is I can't stress how important this is. Confirm your interest rate, your points, what's my down payment, what's my cash to close, that kind of thing. We have all this information in our system. We're happy to share it with you. Okay. Insurance. So depending on your market, we're based in Florida, and our insurance market right now is a hot mess. I don't know if any of you are following it, but we're not in a good place right now with insurance. So this is a recurring theme. Most of the investors we sell our loans to want, obviously, for in their own financial best interest, they want you to buy a more robust insurance. Typically, our borrowers want to save money on insurance and just buy the cheapest policy. And our goal is to navigate the market and find a balance that makes sense. Okay. So there's certain things that are just definite no's. So a definite no would be like buying a personal policy or buying a policy for a tenant occupied property when it's actually vacant and you're ripping out the kitchens and bathrooms. Okay, these are definite no's. You just can't do that. If there's a loss, you're not going to get paid out. Your lender's not going to get paid out, right? That's just silly. A little more nuanced is going to be if it's a renovation loan, we typically want builder's risk on that policy. And then normally we want replacement cost coverage versus actual cash value. This trips up a lot of people. So our team found this little graphic on the internet somewhere. I don't know where they found it, but essentially, like the way I think of it, the way it was explained to me is an actual cash value policy. These are cheaper on average. Replacement cost policies are more expensive. again, on average. But whenever we actually get quotes of the two, the difference is usually not that much. It's, typically a couple $100, okay? An actual cash value policy pays you out, but it pays you out after depreciation. So you can have a estimate of damage that's equal to the loan amount, but then because the home was built in 1960, they're going to depreciate your payout and only give you like half the money, right? And I'm being very vague here. I'm not like the expert on insurance. I'm just giving you my Holiday Inn Express take on this. Okay, replacement cost policy is going to fully replace the damage, so you can bring the collateral back to what it was prior to the damage. The funds are all there. So an actual cash value policy, this is similar to buying a new car, driving it off the lot, and then wrecking it, right? I don't know if anyone's gone through this experience. Normally, the amount of money you get, you can't just go buy a new car with it, because the day you drove that new car off the lot, you lost a bunch of value. So it's the same kind of dynamic at play here. Now, with this being said, we don't make you buy insurance that's cost prohibitive. So if you bring us two quotes, and let's say one of them is 16K and the other one is 4, and the 16K quote is like the better coverage, quote unquote, like we can look at that and get comfortable with the commercially reasonable policy. But it takes time to do that. So remember, up here, you start early, right? If you're scrambling at the last minute, oh my God, my insurance, they don't want it, this and that. It just adds stress when there's no reason for it. Okay. And then lastly, just communicate with your AE. These guys see a lot of deals. They've probably seen the problem that you're going through currently. They've probably fixed that problem for another borrower. So just, communicate with them, ask questions, right? All right. This is, I'm just looking at the questions real quick. I want some good questions, guys. There's a few questions in here. Okay, so these are valuation tips. So we use Richer Values for almost all of our as renovated values. So a lot of people ask us, the borrowers that kind of know the landscape are going to ask, hey, how do you come up with your value, right? Because they're doing due diligence on us as the lender. Like, can you fund my deal on time? Do you know how to do a property value, right? This and that. So a lot of borrowers and brokers are going to ask us, how do we come up with our opinion of value? Generally speaking, we order the Richer Values report, and then I test the property with the account executive. That's our process. We order a third-party report, but then we also just eyeball the property to try to understand the deal. That's our process, okay? The best way to get a value without a lot of hiccups is going to be by obviously arranging for property access. We're trying to get eyes on the property. So if the property is vacant and we can get in there, great. There's 3 ways we can understand the property's current condition, okay? We can, and I'm saying Richer Values is a third party, so their reports are independent. So they can hire a data collector. It's a private contractor in the local market to take geolocated and time-stamped photos of the property and do like a little survey, like, is the roof falling off? Does it smell like mold? They'll like do a little survey. They'll take geolocated and time-stamped photos. That is the most secure way for us to determine the property's current condition. A lot of people confuse this data collector for like an appraiser or the person doing the value. That's not true. They're simply going to the property to get photos of the property so we can figure out A, what is the current condition? What is it currently worth? And then B, we can look at your rehab budget and assess, does that budget actually fix the issues noted in the report? Okay, so that's the most common way for us to get into the property. The second way we can get we can get our eyes on the property is actually, it's called a direct inspection. where someone on your team can get like a link on your cell phone. You just click the link, and then you actually go through the property and you take photos of each room. And those photos are geolocated and time stamped. The third way is we can, upon my loan manager's approval, we can use your photos. Now, for us to do that, it requires a lot of trust, because basically we have to trust that you didn't like Photoshop your photos, you didn't take photos of a different property, and it's happened to us. Like we've seen these types of things. So normally that's reserved for people we have a good relationship with, if property access is difficult to get, right? So if it's a hostile seller or like hostile tenants or something like that, right? If you say, oh, I don't want to drive 20 minutes to the property, like that's not an excuse, right? So if there's like a real reason that we can't get in there and we have a relationship with you, we can sometimes use photos of the property. We want one photo of each room. We also want one photo of each wall of the exterior of the property. We want address verification, so like a photo of the mailbox or the street number, up and down both sides of the street. That's typically what we're looking for if we're going to use supplied photos. And again, we're also looking for a trusted relationship there, that we know that we're looking at the right property. So those are the three ways. Now, I would recommend that you guys just build this into your standard operating procedure, right? Anytime you go buy a deal, you should have a Dropbox account with a 6-minute video walkthrough of the whole house, exactly what you're fixing, and then photos of each room, so that you don't have to go back to the property 15 times during the project. You should be able to send that video to a contractor, give them your scope of work, and have your contractor bid it off the video, right? You should be able to, so like a lot of things we ask for are kind of things you should already have. Anyway, that's just my recommendation. A lot of our more organized borrowers, the professionals, have that SOP built in. So a lot of times if it's a rush deal, we have a relationship, we can just use their own Dropbox video and photos of each room, right? It's all well organized and up to date. Okay. Again, starting early on the value. This gives us time to evaluate the market, get eyes on the property, get comfortable with your scope of work. Okay. If it's a 2-day closing, 3-day closing, and you turn in a $40K rehab budget, we approve it, we get the value back, right? Well, let's say we get the pictures back, and there's no appliances in the house, and there's no appliances on your budget. Well, now we could have caught this mistake that you made had we started earlier, okay? But now it's kind of getting hung up, so then we're scrambling to like fix the issue. So anyway, that's just like a simple example, but there's a lot of things that we're limited on the budgets we can approve prior to the value coming back, because we literally don't see the property. So we will kind of give the budget a pre-check, make sure you filled in the data and gave us some detail, but we can't actually understand the project until we have the report back with photos of the property and your budget to cross-reference. Okay. So the earlier you start, the more time that gives us to correct mistakes that might be made. And then lastly, you want to evaluate alternative strategies. Okay. So the reports we order, they'll typically include a return on investment for what you're intending to do, but they'll also look at other strategies. And that's what I included in this table on the right. Whoops. So you can see on this deal, our borrower is doing a full renovation, but the models actually support a minimum level of renovation. So it gives you like the other strategies that you can do. Okay. So the as is the second line, and the as is 65, right? The as is, it is what it is. Rehab is line 3. You can see like, okay, if we do these different levels of rehab, how much money per square foot is that? And how is that going to lift the ARV? And then it's giving us, basis, meaning total cost into the deal, and net lift. So in this example, and these are algorithmic numbers, so they're not perfect, but it's meant to, on this type of deal, you want to take a second look, because our borrower was doing a full renovation. It's the highlighted column, but the models actually recommended doing a minimum level renovation, right? Save the money, just put in 30K, you're going to lift the value to 110. Don't put in 65 and lift the value to 140 because you're going to take way more time and you're going to get less of a net lift, less of a return. So, and this borrower, I'm familiar with her. She has a BRRRR strategy. So, her tenants are going to not destroy, but her tenants are going to put wear and tear on the property. So, does it make sense to invest 65K, in like a great kitchen and this and that if it's going to get, wear and tear over the next 5 to 10 years? Whereas maybe just a minimum renovation, get it cash flowing. There's a better ROI there. I don't know. It's just meant for you to do a second look. Make sure that, you like your strategy and you feel convicted that you have the right strategy. So, we're not here to tell you how to run your business, but, it can be helpful. So, and then lastly, I'm going to pause for questions because I think we have a few. I don't know how to. How do I unmute? Oh, I can do unmute requests. That's cool. Here, Jason, I unmuted you, and Jamie. I sent you a request to unmute. What do you think, Jason? Did I say anything stupid? Anything you want to add to that? I can't hear you. I don't know. I don't
Can
know
you hear
why
me?
I can't hear you for some reason. I don't know if it's just me.
I can't hear him.
Joshua says something about a tax reduction for homeowners with properties at 750 or below. I'd be curious if that applies to investment properties. Joshua says, do you intend to lend on commercial multifamily? Yes, we do. We do it all the time. Fabian says, call me to discuss options. Yes, your account executive will be in touch. Can you take me off speaker mute to ask some questions? I don't know how to do that. I'm not like the... Yeah, just throw your questions in chat and we'll get to them. I need 150 million for 600 acres. Pass. We do not have the money for that. Okay, any other questions before we end it here? Do you fund auction deals? Yes, we do. So auction deals, it depends on the custodian of the auction. So this is Devaki, nice to see you. Do you do multifamily 14 units? Yes, we do. Do you fund auction deals? So yes, is the short answer, but it depends on the type of auction. A lot of people just kind of paint this with a broad brush. So if it's an REO property, meaning the bank's taking it back, and if the bank has hired a licensed auctioneer to facilitate a purchase and sale agreement between a buyer and a seller, where that transaction will eventually close at a title company or a closing attorney, we can close that deal at the same time of purchase. Okay, so for example, this would be like Hubzu or XOME.com. or some of the auction.com deals. So a lot of people think like these auctions, you got to like pay quickly or whatever. They're not real auctions. They're just gimmicks to get a buyer and a seller to agree on a market price. And once that market price is agreed upon, then you circulate a regular contract, right? It's because I've done it. I've bought these properties off all these platforms. So again, these auctions are not actually auctions. You're just kind of bidding. A lot of times you won't hit the reserve and the property comes back a week later. So anyway, it's just a gimmick to get a buyer and a seller to go into a normal contract, and then that normal contract closes at a normal title company. So more often than not, that's the auction that you're talking about. So if it's an XOME deal or a Hubzu deal or most auction.com deals that are not with the foreclosure filter but the REO filter, it's a normal deal. We can fund it at closing with a standard title policy. Okay. If it's a live auction, right? Sometimes you see these estate sales where you'll have like a live guy, auctioning off property out of the driveway. Same thing. They're just going back and forth trying to get someone in the audience to bid the most. But once that person raises their hand, you go into a standard purchase and sale agreement. You close a month later with a standard title policy, right? I've bought those deals in live setting. So our loans work really well with all of these types of auctions. The auctions that are a little bit trickier are going to be your sheriff sales. This is when a borrower is not paying back his lender. The lender forecloses, and then the lender wins their lawsuit, and then the judge, through final judgment, gives the lender the authority to sell the property to the public, to a third party bidder, or the defendant really, for the amount that they're owed on that judgment. Okay. These types of auctions are a lot trickier. I've also bought property off these types of auctions. These types of auctions, typically you have to pay within a day of high bid, and typically you do not get title insurance or a marketable title policy. So you really have to know what you're doing, and I would advise that really the professionals stick to those types of transactions. But if you do buy one of those deals and you do your pencil search properly and there's no liens and you didn't buy a second mortgage and so on and so forth, we can do a delayed purchase and get you your money out of that deal in like a week or two, as soon as title's ready. So those are how auctions work. Do you work with other private lenders for referrals? We typically do not provide construction loans and would like a lending partner to refer to. Absolutely. Let's send Jason or Jamie on the screen an email, and they would love to work with you. Okay. Which states would you not want to fund in? I'm going to go back to this slide. So I know it's kind of small, but the restricted states are in the middle here, and we can get you a guide. Jesus Acosta, thank you for that question. So Arizona, California, Idaho, Minnesota, Nevada, North Dakota, Oregon, South Dakota, Utah, or Vermont? Yeah, VT. Okay. Anywhere else, we are live funding deals. Timothy, looks like you did an auction deal. Cool. Hopefully we can, well, you probably went through. I'm curious which kind you bought. Good for you, man, out there doing deals. And then Joshua is talking about the county auctions. Yep, you can do those. Just be careful, man. Do a title search. Even though you're not going to get a lender's title policy when you buy it, you can still have a title company that you close a lot of deals with kind of do a title search for you. And just that's expensive though, right? if a one-off title search might be $100. There's vendors online that do this. I can't remember the name of them, but there's some vendors that do this, and obviously if they miss something, you're on the hook. So just be careful. But there's vendors that will give you a search. So you really want to be able to buy a lot of deals if you're doing those sheriff sales, because if you get like a couple wrong, if you get like one wrong, you don't want it to like tank your year. Do you fund on novation deals? No, we do not, sadly. I wouldn't even know how to do that. Although I will say we've done a joint venture where if our company takes title, this is Florida only, but we might do it in other states. So if you buy a deal and you don't have the cash to do it, we have a really good deal. So what I've done before with some people, it's a very short list, but we'll buy the deal, we'll take title, we'll do 100% of renovations, 100% of cost, we will sell it, and then we'll do some type of profit split at the end. So that is that's a strategy that we've done with a few people. So we don't offer 100% financing, but that basically is 100% financing. How you work with lot purchases. How you work with lot purchases. So normally a lot is purchased with the intention of building a ground up construction. And as you can see, our ground up goes up to 85%, unless there's other adjustments. So just call it 80% for round numbers. So on a ground up construction, if you're doing, let's say we're doing an 80-20 deal. Well, typically in most markets, the land is like equal to the 20%. It's kind of funny how that works. So it's just usually easier if you buy the lot in cash, and that works as sort of your down payment. And then we come in and we fund 100% of the construction. Now, obviously, we're going to balance the numbers and get it precise, but generally speaking, it is best and easiest if you just buy the lot in cash. Then you start your plans, start your permitting, get everything rolling, connect with someone on my team, and get that deal in processing. Okay. We've looked at funding ground ups simultaneous with purchase of vacant land. There's a few problems with that, although we're still looking at this. There's a few problems with that. So the first problem is if we were to fund a ground up at the same time you purchase vacant land, number one, your building permit can just get declined, right? So now you've paid us 3 points on a house you can't build. So so to try and save a $200 title fee for 2 closings, you've actually cost yourself, 10 grand in lender fees and all this other stuff and insurance you can't use, right? So that's the first problem with it. The second problem with it is typically we do a 12-month term. So you're starting your 12-month clock before you can actually build with a building permit. So those are the main reasons against doing it that way. The main reason for closing a vacant land ground up construction deal, the main reason for it is to avoid paying your title company twice. So we're not naive to that benefit. I know that's a real thing, but in our estimation, the downside of that, the upside of not having to pay your title company twice is not worth the risk of potentially paying a bunch of fees on a house you can't build and starting your 12-month term before you have permission to build. So we, generally speaking, advise that you buy the land first. What are the requirements to be qualified for a fix and flip loan on the first time buyer? How do I'm going to give this one. Hey, Jason, I made you the presenter. Try chatting. Can we hear you? Can you guys hear Jason?
No.
I don't know if it's just my system or what. Okay. I don't know. Can they hear you? not sure. No, they can't hear you. Sorry. All right, I'm gonna make myself the presenter again. Sorry about that. All right, we'll get this figured out next time. I need to do a trial run and get the technology figured out. I apologize for some of the disorganization. Let me get back into these questions. So the requirements to be qualified for a fixed book loan, first time buyer. So if you own your primary residence, it helps. It's not necessarily a hard requirement, but it helps a lot. What you cannot do is you cannot live in the property. And we see a lot of people that pitch us deals where they tried to do FHA financing and it failed. And now they think they can just put the deal in an LLC and it's fine. That's not fine. That's not what we do. If you're legitimately buying your first fix and flip as an investment property, all you need is a little bit more money down. That's it. So we do work with first timers. It's fine. You just got to put a little bit more money down. Other than that, it's all of our programs are the same. So don't overthink it. It's just buy a good deal, put a little more cash down, and we'd love to close with you. When requesting funding for these deals, is it a hard or soft pull when dealing with credit? So what we are doing currently is we're doing a hard pull for a 6-month period, and we use that score for 2 months. Between month 3 and 6, we do soft pulls to update your terms. We are looking at possibly doing 1 hard pull per year. I'm not there yet, but we want to have less of an impact with our hard inquiries. So we're looking at lowering the frequency, but right now you're going to get maximum two inquiries per year, usually less. How about if you want to buy multiple lots to speed up permitting process? We go as fast as you guys do. So as fast as you turn in your documents is as fast as we close. So you can be zipping around buying 64 lots and you can turn in all your budgets and buy your values and get your permits ready. We're going to be just as fast as you are, and we welcome the challenge. Do you care about funding the source of the down payment? We do. So on this one, I know there's some lenders that don't. For us, we do kind of a soft gut check against anti-money laundering, right? We do sort of a soft gut check against straw borrowers. But we also are a storybook lender, okay? So we're going to look at the story of the deal, and if it makes sense, more often than not, we're just going to do it. The issue with so let me give you 2 examples. So example 1, right? We've got a borrower that we've done 9 loans with. He's paid us back 7 times. He's got 2 deals on the market. He's a little bit short of his down payment, and he called his buddy to borrow 40 grand unsecured last week. Okay. Do you think we would approve that if it was buttoned up and the letter made sense? Who thinks we would decline that loan? We would not. We would be totally on board with that. Okay. So that's a borrowed down payment in air quotes that we would be totally okay with. Let me give you another example. Okay, borrower has no experience. They're renting their primary residence. Their contract was written in their personal name with conventional financing with 3% down. It got declined by Rocket Mortgage, and then a broker sent it to us and said they're borrowing 20% from their uncle. Okay. Who thinks we would be comfortable with that deal? We would not. So we would kick that. So it's just a storybook thing. If it makes sense, we're going to do it. End of story. I appreciate you all. We appreciate you too, Joshua. Thank you. Anything else? Need to hop off. Good webinar. All right. Thank you, Jason. All right, we're going to end it here. Again, my team is on the screen here. Jamie, Jason, Tom, and Jason. Please reach out to these guys. They are experts. They've closed a lot of loans. I mean, I just can't speak highly enough of my team here. You know, Tom, ton of experience, has seen our business grow. Jason's closed a lot of loans, seen a lot of, knows exactly what we're going to fund. Jamie's doing some really good volume, ton of experience there, and Jason, just a wealth of knowledge there, with the way the entire market works. So reach out to these guys and let's close some deals. And with that, I'll see you guys later. Bye now.